Hello everyone, welcome to another video on this channel. Today we are going to explore a very interesting category of mutual funds called as the value category. As you all know, the purpose of this channel is to explain the basic concepts of mutual funds and mutual fund investments in a very simple and easy to understand way to new mutual fund investors. So if you are somebody who is looking to explore investments in mutual funds, or if you want to know the basics of the various categories which are present there in the market, this is the right channel. My name is Paresh. I am an NISM certified and AMFI registered mutual fund distributor and advisor. This is my ARN 334516. So let's go deeper into this category. Before we move ahead, this disclaimer is very important. Mutual fund investments are subject to market risk. You need to read all scheme related documents carefully. The past performance of any mutual fund scheme is not necessarily indicative of future performance of the schemes. So when a new mutual fund investor comes into the market, the first feeling that they have is that of a confusion, right? So today, if you go on the website of almost any mutual fund company in India, you will find at least 50-60 different types of schemes. There is flexi cap, hybrid debt, mid cap, large cap, ELSS, multi cap, equity savings, and so on. So what is all this, right? uh, Obviously we all have heard over the last say 10 years, mutual fund sahi hai, mutual fund sahi hai, which means mutual fund is the right vehicle, and that is true. Especially if you are not really aware of the basics of investing or the basics of stock markets, a mutual fund is no doubt the best investment vehicle for people like these. But remember that not every mutual fund scheme is right for everyone. Every scheme has its own investment objective, its own investment framework, its own risk profile. So depending on what your investment objective is, what your risk profile is, and what your investment horizon is, uh, there could be some schemes which are perfect for you, and there could be some schemes which are absolutely not right for you. And that is the role of a mutual fund advisor. Uh, we are here to help you choose the right schemes which would help you achieve your financial goals in future, right? So at the end of this video, I will give you my contact number. You can contact me on that number if you are looking to invest in mutual funds, and I would definitely help you choose or select the right schemes which are perfect for you, for your risk profile and for your investment goals. So what are value mutual funds, right? So in very simple terms, funds that follow the philosophy of value investing. So value investing is perhaps the oldest method of selecting stocks or stock picking. Right. So this framework was developed from a concept by Columbia Business School professors Benjamin Graham and David Dodd in 1934. So it's almost 100 years since this framework was put into place. And some of the all-time great and most successful investors in the world are the followers of value investing. So they are the disciples of Benjamin Graham and David Dodd. So you must have heard the name Warren Buffett, right? One of the most successful or legendary investors in the history of investing. Warren Buffett was a student of Benjamin Graham, who developed this value investing principle, and Warren Buffett has lived by that principle of value investing, and he has publicly said that all his success, whatever the money that he has made for himself as well as for the shareholders of his company Berkshire Hathaway, is completely because of this value investing framework. Then there is Charlie Munger, who was the business partner of Warren Buffett. Peter Lynch, we have actually created a video on Peter Lynch on this channel. If you have not watched that video, I suggest you go and watch that video. It's a fascinating collection of uh, some pearls of wisdom from Peter Lynch's investment journey. If you have not watched that video, Peter Lynch is without any doubt the most successful actively managed mutual fund manager in the world. He was the fund manager for Magellan Fund in USA, and over 13 years, that is 13 years, this fund delivered an annualized an average annualized return of around 29%. in a stock market like USA, to deliver a 29% average annualized return over 13 years period is nothing short of a miracle. There is no other mutual fund in the world, not just in America, but anywhere else in the world, which has delivered these kind of returns, right? So this is a very well established investment philosophy, and value mutual funds are those mutual fund schemes which stick or adhere to the framework which is outlined by Benjamin Graham and David Dodd, right? So what does it involve? I mean, we for I think last 2 minutes we heard so much about value investing. You know how some of the all-time great investors are basically disciples or followers of value investing. So it is a very simple framework. In very simple words, it means buy low, sell high. Right? You have to identify stocks which are trading below their intrinsic or inherent value, buy them at that value, that price, and then sell when their price rises. Right? So basically, it involves identifying undervalued companies that are trading below their intrinsic value. Now, intrinsic value is determined by various financial analysis methods such as DCF valuation, comparables, etc. Uh, getting into the details of this methods is not really the purview of this particular video. It would become too complicated and most of you would probably not understand it, but just understand that identifying the intrinsic value of a business is not magic. Okay, it's not guesswork. There is a mathematically proven formula which you can use to arrive at a number or at least a range which tells you what should be the fair market value of a company share, right? And based on that, once you have done that analysis yourself, obviously it involves making a lot of assumptions, but once you are good at it, once you understand that particular industry in which in which the company is operating in, you can run this analysis uh, and arrive at a range that would indicate what is the fair market value of that particular company, and if the company is currently trading below that range. you know for example, let's say you did this analysis for a company, and you came and the answer of that analysis is that the fair market value of this company is say 90 to 100 rupees per share. But let's say that company share is trading at 70 rupees in the market. You go ahead and buy it and just hold it, because sooner or later the share is going to appreciate to that range, somewhere between 90 to 100, and that is when you make your profits, right? If you remember, we discussed investing briefly in a video on this channel. I had done a video on the multi-factor funds. This is a very recent category or investment strategy, and value investing was one of the factors which is considered in multi-factor funds. But that was a very briefly I had mentioned that over there. If you are interested, you can go back to that video and understand what that multi-factor category is. But remember, value was one of the factors considered there, and these mutual funds, which are value mutual funds, focus exclusively on this particular factor or the investment philosophy which is called as value investing. The hallmark of this investing strategy is that it's focus on quality, right? The analysis or the fundamental analysis, it's called, which is done on a company's share price, focuses on quality of management, quality of its business, and the quality of its financial statements or the financial health. If any of these parameters do not make the cut, a value, a true value investor would just discard that stock from their portfolio, right? So if the business is good, if the financial health appears to be good, but if the management is not competent, or they have a history of uh, unethical behavior, such as mistreating the minority investors. uh, these are some technical terms, but remember that management quality, it's not really some airy or fluffy kind of a term. Management slash promoter, even promoter quality comes into the picture. So promoters or management which have a history of mistreating the minority shareholders are typically investors like you and me, okay, retail investors or even they could be mutual funds which have a very minority shareholding in the company, maybe 1 or 2% of the total shares outstanding. But if they are taken for a ride by the management or the promoters, it's not a good company, right? No matter how good its business might appear to be, how good its financial health might appear to be, a true value investor will never invest in that kind of a company. Another hallmark of this investing philosophy is that it's long only, which means a value investor will always have a very long investment horizon, typically lasting for 7 to 10 years. Warren Buffett, I don't know how many of you have heard or read about him. Warren Buffett famously says that our favorite holding period is forever. So, the essence of value investing is that you identify good businesses, you identify good companies which are run by good people, people with integrity, people who are dedicated to growing the company. You identify such companies in a good industry, and such companies, if they have very good financial health, you buy those stocks and just hold them forever because you know this stock is only going to appreciate. You will get tremendous value from dividends. You will get tremendous value from the share price increases which you are getting. So that is the essence of value investing. I'm spending a lot of time on this because this is something incredibly important, and I'm personally quite fascinated by this investment philosophy. I've done a lot of reading on this, and the final point is that studies have consistently found that value stocks outperform growth stocks and the market over the long term, right? So if you really follow this value investment philosophy, and if you take very high conviction bets and you hold these stocks for a long term, you will always get a return which is far higher than any other category of stocks or any other factor, and you will always beat the market, right? So if your benchmark is say the BSE 100 or the Nifty 50, if you really follow the value investment philosophy to the letter, and you hold your positions over a long time, you will always outperform the market, right? So the essence of this value investing is that, okay, the stock market may appear like a casino or a game in the short term, right? So a lot of us, especially people who are new to the world of investing, or don't know much about stock markets, have this myth in their mind that this is all like a satta. Like satta is the Hindi word for a casino. See, in the short term, it might appear to be like that. You will always find stocks which are like multiplying every month, hitting upper circuit every day over a long period of time. You'll find a lot of news articles or hot tips which say that this stock has given 300 400% returns in 1 month. But remember, a lot of these stocks are what are called operator stocks. There's no fundamental quality to that particular company. This is all hype. This is driven by liquidity. This is driven by various vested interests. But in the long term, in any stock market, whether it's the most advanced stock market in the world, like the American stock market, or even a very, very nascent stock market, like some very underdeveloped country, in the long term, only quality companies with sound business models, strong financials, and competent management will create value. That is the essence of value investing. And the value investment framework or value investment philosophy aims to identify such companies and buy them at prices which are below their intrinsic value. So this is the book which was written by Benjamin Graham. This is the professor, right? We talked about in the previous slide, Columbia Business School, which is in the USA, and he has written this book, which is widely known as the Bible of value investing. Right? Warren Buffett, who was the student of Benjamin Graham, has actually written a preface to this book, right? And he has explained the importance of this book and why all investors should read this book. So simple. This book precisely and clearly prescribes a proper framework for making stock selection decisions. Right. Look at the final line. Ben's principles have remained sound, their value often enhanced and better understood in the wake of financial storms and demolished flimsier intellectual structures. It is not an exaggeration to say that every other investment style, whether it is momentum investing or any other factor, it basically derives from value investment or value investing philosophy. And this is the essence of this philosophy. We have seen, I think we have spent around 10-12 minutes on just understanding what value investing is. If you are really interested in knowing more about this, I highly recommend this book. As I told you, world over, almost every successful investor in the world has followed this book. They have read this book. This is like the Bible of value investments, or the Bible of value investing. It is widely known, and it is not an exaggeration. Okay, this is a big book. This is not a 40-50 pages book. It would probably take you, I don't know, 20-25 hours. It took me close to that. You might finish it in less number of hours or more number of hours, depending on your speed of reading and comprehension. But trust me, those would be the best hours that you have spent when it comes to your investment journey. So why invest in value funds? Okay, so first point is that proven investment philosophy. I have spent close to, I think, 12-13 minutes trying to tell you why value investment is probably the basis of almost every investment philosophy that there is, right? So this is a proven investment philosophy with over 80 years of verifiable data from the US markets on outperformance. So there have been multiple research and studies done which show that value investment or value investment philosophy has outperformed any other investment framework over a long term. Diversified portfolio. So stock selection typically happens across market cap segments and industries. And then there is the twin benefit of earnings growth, right? So when you invest in value stocks, or basically value funds which invest in value stocks, you get twin benefit. One is the earnings growth, and the second is the re-rating of valuation multiples, right? So once you have identified an undervalued company, right? Obviously, as earnings grow, you will get more and more dividends, right? But additionally, as the company becomes well known, its valuation multiples will rise. Right? So if the company was trading at a PE, which is a price earning ratio of I don't know, maybe 14 or 15, once the company or the stock price becomes known, the investor interest increases and the PE multiple goes up, which means the stock price goes up. So your investment will multiply over a long term once the market knows the true worth of any company which you have identified earlier. And final point is that it's a disciplined approach, right? So each fund has a clearly outlined and quantified framework of stock selection. I will list some well-known value funds in the slides to come. You can go on their website and look at their investment strategy. You will find in most of these cases they will have a well-defined and clearly quantified framework. Right? So they will say that we will only invest in the stocks which have a PE ratio in this range, or PB ratio, which is the price by book ratio, in this range. And then they will have some similar frameworks for selecting sectors or selecting the various market cap segments. So this is one example of diversification and value mutual funds. This is the fund fact sheet of HDFC Value Fund, right? So if you look at the industry diversification, you have financial services, IT, healthcare, automobile, FMCG, telecom, and on the right hand side you will see the market cap segment, segment wise exposure. So large cap is around 68%, mid cap is 14%, and small cap is 17%. So you're getting exposure across industries and across market cap segments. And because the inherent nature of value investment philosophy, undervalued companies could be found anywhere in any sector and any market cap segment. So this is how you get the kind of diversification. So let's look at the category returns. Okay, how has value as a category has performed over the years? So these are some of the prominent equity mutual fund categories. And if you look at this value-oriented equity mutual fund category, let's look at 10 years returns, because value investment is inherently long-term in nature. So this strategy or this category has delivered a return of around 14%. This is the annualized return. So, and if you look at it in terms of comparison, this is more than flexi cap, and this is more than large cap, and this is more than large and mid cap, right? Or even ELSs for that matter. Note that this is a category average, so there would be funds which have delivered returns which are more than this, and there would be funds which have given returns which are less than this. So let's look at some of the well-performing value mutual funds. So these are a few which I have kind of outlined here. Almost every mutual fund company has its own value fund. Note that not every mutual fund company will name it as value fund, right? So there would be funds which are actually following value investment philosophy, but they will not name it as value mutual funds. Secondly, almost every investment philosophy, as I told you, has its basis in value investing. So other than funds which are explicitly focused on other factors like a momentum fund or a growth fund, most of these funds, even though they may not mention it explicitly, they follow value investment philosophy to a certain extent or to a major extent. But the reason of kind of separating this category is that kind of identify funds or put together a fund which focuses solely on the basic principles of value investing. So these are some of the funds, and if you look at the 10-year return, they fall in the range of around 13 to 14%, which is a very good return. Okay, anything in excess of around say 12% over 10-year for a pure equity mutual fund is a good return. So if you're looking to start your mutual fund investments journey, you can contact me. This is my WhatsApp number 975730929. I would definitely help you choose the right schemes, basis your investment returns expected or your investment horizon or the kind of goal that you're planning for. Alternatively, you can scan the QR code which is displayed here. You can download the Funds Bazaar app, register yourself, and start investing in mutual funds from there. If you're not comfortable investing via an app, in the description of this video, I will give the link to the Funds Bazaar website. You can click on that link, go on that website, register yourself, and start transacting. So this was a video about a very, very important and very interesting investment framework called as value investing, and the category which employs this investment framework called as value mutual funds. I hope this video was insightful for you. If you really like this video, please share it with your friends. Subscribe to the channel. We will of course cover a lot more mutual fund categories on this channel, a lot more concepts about mutual funds, investment philosophies, and so on. Thank you for watching this video.